Hi everyone, this is our technical analysis on EURUSD. Let's start with some fundamental background first. Last week, the Fed hiked by 25 bps as widely expected and left everything unchanged. Fed Chair Powell in the press conference just reaffirmed their data dependency and kept all the options on the table. The economic data since the FOMC meeting has been supporting the soft landing narrative, as the labor market data remains strong and inflation data missed expectations. The ECB, on the other hand, hiked by 25 bps as expected and changed the line in the statement that lent more on the dovish side. President Lagarde didn't hint to what we can expect next, and in line with the Fed, just reaffirmed the data dependency and kept all the options on the table. The data for the Eurozone has been consistently missing expectations, but the recent inflation and employment reports remain strong. On the daily chart, we can see that the failed breakout of the top trend line here led to a big sell-off back towards the 110.33 level. This was a key resistance that turned support once the price broke above it here. In fact, the buyers were waiting to position for another rally with the red 21 moving average for confluence. Unfortunately, after a brief rally, the price reversed again and broke below the support and the moving average, eventually bouncing on the upward trend line. This would be the last line of defense for the buyers, but the bias is now more bearish as the price has been printing lower lows and lower highs, and the moving average have crossed to the downside. Drilling down to the 4-hour chart, we can see more closely the brief rally here from the support and then the sell-off as the US jobless claims came in much better than expected. The price is now consolidating near the trend line and the 110.33 resistance. From a risk management perspective, the sellers would have a better risk to reward setup near the downward trend line here, where we have also the confluence of the resistance and the 50% or 61.8% Fibonacci retracement levels. The buyers, on the other hand, can either start positioning for longs here at the trend line or wait for the price to break above this downward trend line to pile in more aggressively and target a new high. On the 1 hour chart, we can see that on this time frame, the price has made a new higher high here and the moving average have crossed to the upside. This signals that the bullish momentum is prevailing in the short term, and we might see the price rallying all the way up to the downward trend line. If the rally fails, though, and the price breaks below the recent low at 10945, the sellers are likely to pile in more aggressively and extend the fall into the 10832 swing level. Today we have the US ADP, which is generally a less reliable labor market indicator, but it can move the market nonetheless. Tomorrow, the market will be focused on the US jobless claims and the ISM services PMI. On Friday, all eyes will be on the main event of the week, the US NFP report. Strong data for the US should support the US dollar, as the market would lean on the more hawkish side. On the other hand, weak readings should weigh on the greenback, as it would give the market more confidence on the end of the rate high cycle.